Hey everybody, welcome to That Expert Show, where you help run the show. I'm Anna Canzano. Thanks so much for joining us for this episode as we talk about health insurance. It can be really confusing, especially if you have had a change in your job situation. You're no longer with an employer who is providing the health insurance that maybe you've received over the years. If you're trying to go out into the marketplace and figure out what plan is best for you and your family. Let's say you own a small business and you're trying to figure out if you can afford to offer health insurance to your employees as a benefit. All of this is kind of tough to tackle and can be overwhelming. So this is a great episode for you to watch or listen to. Welcome to those of you who are joining us via our partnership with the Oregonian. And if you feel like this is an episode that can help someone that you know, feel free to share it right now with folks. And also feel free to chime in with a comment or a question for our expert tonight, because I guarantee she'll be able to answer it. Our guest tonight is an insurance broker in Oregon, Washington, and California. She services businesses usually that have less than 50 employees that want to attract and retain high-quality staff. She is one of Amazon's #1 best-selling authors with the book Health Insurance Secrets Revealed, and she has an upcoming book on 101 employee benefits for all budgets. So joining us live right now on That Expert Show is Gladys Boutwell. Gladys, thanks so much for being on That Expert Show.
Thanks for having me, Anna. Great to be here.
Gladys, I wish that you could begin by giving us an overview of the insurance landscape, because I think this is such a confusing field for most of us, and I don't really even know where things stand in our country in terms of the Affordable Care Act, what is covered, what is required. Could you paint a picture for us?
Sure. So with the Affordable Care Act, it's still here. Some people think it's going to go away. If it does go away, it's going to take a few years because it is impactful. You can't just take it away when we've had it for so long and it's helping a lot of people. One of the things that has happened, and it's still happening, is through the American Rescue Act, there were additional monies that were put into the Affordable Care Act. What does that mean? Well, there's a couple things that it means. One is that individuals that were getting a tax credit started to get a higher tax credit. That was number one. Number two, which I thought was the greatest thing, before, if you made over $50,000, you went from getting a tax credit to getting no tax credit. And so the way that it is now is that the more you make, the less you're going to get, rather than just being cut off automatically. I have families now that are making 120,000, even 140,000, and they're still getting a tax credit because of the size of their household. Everything is based on household size and income and where you live. So there's a lot of different things that play into how much you're going to pay. The one thing that is important for everybody to know is that the price of the plan is the price of the plan based on your age and where you're living, period. Now, what you pay is then dictated by the tax credit that you're receiving. That's what reduces your monthly premium. So your income can go up or down during the year. That can be adjusted. But what is going to stay is that constant of your premium being the premium based on your age. So the Affordable Care Act is still here. People say, I don't want an ACA plan. Well, guess what? Unless you're getting a non-ACA compliant plan, one that's an indemnity plan, even if you're not going through the marketplace, guess what? It's still an ACA compliant plan, which means that it has to follow the rules and regulations that have been put into place, which means it has to have your preventive, it has to have baby wellness, it has to have physical therapy, rehab, ambulance, emergency, it has to have prescriptions. All of these things are already embedded into the plan. So you can't just pick and choose and say, well, I don't want this, I don't want that. It is already part of the plan. So even if you don't use it, you're still paying for it. So that's what's happening across the board. But there are some plans that some of them are those that are, they usually call them Christian-based because they are, it's a pool of money that's being put in, and whatever happens to the person, if you go to the doctor, it's being paid for by this pool. That's similar to an indemnity plan. An indemnity plan is usually covering the cost of your health care up to a certain dollar amount, and based on what is happening, what you're utilizing it. And those are not as popular, but they're still out there, and you can still get them, and you can save sometimes as much as half of what you're paying for an ACA plan. But you also have to be a very healthy individual, because if you have any pre-existing conditions, guess what? You're not going to get it. If you have pre-existing conditions, a traditional plan, if you will, if you don't want to say an ACA plan, but just a traditional plan is going to be your way to go.
I'm curious, since you know the industry so well, having been in it for so long as an expert, do most people these days have health insurance covered through an employer? Or are most people on some version of public funded health insurance, or are they buying their own insurance in the marketplace?
That's a great question, and it depends on the state. Oregon, Washington, California are states that have taken the what's the Medicaid, or your Oregon health plan, or Washington Apple, if you will, Medi-Cal in California, where the income, everything is based on the income. So where is your income will determine if you can, if you're going to be able to go on what would be considered maybe a public assistance plan, the Oregon Health Plan, Washington Apple, Medi-Cal. For a single person, for the most part, if you're making less than $19,000, if you have no dependents, you're probably going to qualify. If somebody qualifies for Oregon Health Plan, they can waive off their group plan. So if an employer offers them insurance, they can say, thank you very much, but I'm on Oregon Health Plan, or I'm on Medicaid, and that's okay. Percentage-wise, I can't give you exact percentages, but I do know that there are a lot more small employers that are offering health insurance. They see the importance of providing benefits in order to attract and retain quality staff. And I've noticed that over the last couple of years, after a lot of employers lost their staff, now that they're trying to bring them back, they're saying, you know what, there's so much competition out there. If I don't offer these value adds to my staff, then they're going to go somewhere else that they're going to get their insurance paid for, even if it's at 50% by another employer. So it's depending. And then there are some employers that say to their employees, I'm going to give you $300. It's a health reimbursement arrangement. Go get your own health insurance. I'm just going to reimburse you $300 a month. You can use that for your premium, and some of them will allow them to take that money and use it towards their co-pays or their deductibles. So it just depends on how it's structured, and it depends on the budget that the employer has and what are the things that are important to them and their staff. So that's the determining factor.
So for people who do have coverage through an employer, what are common things that you see people missing out on, or that they're making mistakes about strategically? Because I know that even with an employer, there's always choices that you can make about what plan you have and what add-ons you decide to exercise.
So one of the things that they don't know is that a lot of plans have value-added programs that they can have access to. One of them is, and not all of them, so they have to really look at what does my policy offer. One of them is employee assistance program. They may have 3 or 4 either virtual or in-person visits to a situation. So they can be having a problem with their oldest child that keeps getting in trouble at school. And so they can call a counselor and say, I don't know what to do. And so they can get 3 visits to that counselor on that one situation. Then they're saying, you know what, I'm having budgeting problems. Sometimes it's even a financial counselor that they can call and saying, hey, I just need some guidance on how to put a budget together. Then they have the youngest one that they're having a hard time getting them to do their homework. Well, then that's another 3 or 4 calls to a counselor to get guidance on how to manage that. So that's one thing. Another thing is that some plans will give you maybe $100 gift card to Amazon or just a Visa gift card just for simply doing a health assessment, which could be setting up your account online, answering some questions, and maybe even doing a biometric screening. It is not going to affect the plan, nor your insurance, nor you're going to be kicked off. But it's trying to say, hey, these are things we've assessed. You're pre-diabetic. Your cholesterol is a little too high. The reason the insurance companies will do this is because they want the individual to be healthy so that they can prevent them from getting into a bigger problem in the future. I.e., they're now on insulin, or now they had a heart attack because their cholesterol was too high. Whatever it may be, it's going to help the individual stay healthy. Sometimes there's even some health coaching, some discounts on gym memberships, $25 gym memberships that they have access to. So these are things that they don't even know that they may have. And then one of the mistakes that they sometimes do is that they think, oh, I have health insurance, I can go wherever I want. All the companies have a network of providers, and they go outside the network of providers, and then they get this huge bill. So it's not making sure that their providers are in network, or if their primary care is in network and they need to be referred to a specialist, they don't make sure that the specialist is in network. They think that because their doctor said go to this doctor or this specialist, that specialist is in network. That's not the way it works. They're going to send you to who they think is the best provider. That doesn't mean they're in network. So if you know there's a specialist you need, before you go see your primary care, you look up online, is the specialist in network? And then when the doctor says, yes, you need that specialist, then you can say, hey, doc, this is where I want you to send the referral to this particular clinic, to this particular doctor.
Let's talk through as well the whole notion of a high deductible plan versus a low deductible plan, or something in between. I think a lot of times people shy away from a high deductible plan because they think, well, there's just no way that we're going to reach that level of care over the course of a year. I'm not going to get to $6,000 or $7,000 worth of care before my deductible finally is met, and then everything after that is fully covered. Can you talk me through the different factors that people should be weighing as they make that decision, probably with a company that they work for, as they're choosing between a low, medium, or high deductible plan?
That is a great question, because a lot of people, they'll either go with the cheapest plan, which is high deductible, or they'll shy away from a high deductible plan because they're never going to reach it. So it just depends on the individual's mindset. What we need to look at is the individual. What are their specific needs? Are they going to get pregnant? Or are they pregnant, and are they going to have a baby next year or this year, whatever it may be? Do they have high needs? Are they on dialysis? Do they have to get treatment for leukemia? My clients that have those issues, if you will, they're usually on a low deductible plan, a gold plan. And the reason they're on a gold plan is because they have that lower deductible, maybe a $500 or $1,000 or $1,500 deductible, and they have a lower max out of pocket. So the way that insurance works is that you have to meet your deductible for, could be labs, x-rays, emergency hospitalization, surgery, anything that's a procedure. You're subject to the deductible. So you have to pay that first $1,000. Then you're going to pay 20%, sometimes 10, depending on the plan, 10, 20%, then up to a total max of whatever it may be. It could be $5,000, $6,000, $7,000. That's your max out of pocket. Once you reach your max out of pocket, that's when the insurance will cover at 100%. If somebody is healthy, hey, I go to the doctor once a year, maybe twice a year. I need my annual physical, and that's it. You know what? That high deductible plan may be okay. It can be considered a catastrophic plan. If I happen to end up in the hospital with appendicitis, guess what? My max out of pocket is $8,700. Guess what? You negotiate, and then you get on a payment plan. You do not have to pay the full amount up front, but it will cover if you are hospitalized, if you have surgery. It will also cover your preventive annual physical. Once a year, you get that annual physical. You get your mammogram, you get your pap, and depending on your age, over 40, colonoscopy. You get your free flu shot, and there are some preventive medications. The thing with that higher deductible bronze plan is you're going to pay more when you are actually sick and see the doctor. You're going to pay more if you go see a specialist. And generally, only generic medications are covered. Everything else you're going to be paying out of pocket. So you have to look at what is most important to you. Or is it having that catastrophic plan and still making sure you stay healthy? Or is it, hey, I got something that I know I have to take care of, which means you're going to pay more monthly, but you're going to have less out of pocket. And I do the calculations with my clients a lot of times to see what's going to behoove them in getting a bronze, a silver, or a gold plan. It all depends. And you will hear me say it depends a lot. My clients hear that a lot because insurance is very specific to each person and their needs.
Does it stand to reason, though, that folks who are getting older, let's say they are reaching their mid-50s and they're creeping closer to retirement age, and I don't think it's unreasonable to think that people who are of that age, things start happening with your body, joints aren't working as properly as they should, cholesterol might be going up. There may be a need for some kind of orthopedic surgery in that age range. So does it stand to reason that people, generally speaking, within that age range and above should maybe look with a keener eye toward a lower deductible plan?
Depends. Some of them will, some of them say nope. I started having all sorts of issues after I turned 40. It was like, oh my goodness, how many issues could I possibly have? Whereas before, I'd go to the doctor once or twice a year, annual physical, and maybe I got sick once. That was it. I never went to the specialist. I think I went to a dermatologist once. So all your ologists, your dermatologists, hematologists, those are all specialists. I went to one once. I think that was it. As we get older, yes, we need more care. And a lot of times that silver plan, that in the middle plan, works out just fine, because as we start getting older, yes, we're probably going to need a specialist. We're probably going to need more medications to take care of certain things. And having a silver plan will give us that option. We may not need that gold plan, but a bronze plan is a little bit more on that person that is truly that healthy younger individual. And I do have those individuals that are in their 40s and 50s that are on a bronze plan because I've never been sick in my life. I just want a catastrophic plan. And because they don't have medical history that is needing to be covered, that bronze plan is still okay. But yes, as we get older, we really need to start looking at slightly lower deductibles, because guess what? We might actually reach them with the number of procedures. I mean, I had ultrasound, 2 ultrasounds done in January and February, and a bunch of blood work. And as my doctor wanted to check all my hormones, that was outside of the preventive, so I had to pay for that. So all these things are important to look at as we get older. But then if we are older and we have a business, we may want to look at a health savings account, an HSA account. That means that you have a beauty of an HSA account where you can pay less for the plan, but you're going to be paying all those dollars up front. But the beauty of it is when you talk to your tax professional is it beneficial to that individual, to that business owner, to have an HSA, because it's going to help reduce their taxable income. No matter how much they spend on an HSA, whether it be $500 or $5,000, it's a write-off. Whereas your traditional non-HSA plans, you can't do that. You have to reach a certain amount over the percent of your gross income before you can write any of it off. And then with the max out of pockets being so low nowadays, most people can't even write any of it off. So it depends on situation, depends on the tax circumstances, depends on the person's health, and it depends on what could possibly happen, that golden, that crystal ball that's going to tell them that they're going to need a surgery in 6 months with their appendix. Don't know.
Right. No, none of us has that crystal ball, unfortunately, right. But sometimes we get little hints along the way that there might be something coming up. Let's dive a little bit deeper into the health savings account. It does differ from a health retirement account. So benefits of a health savings account are that If you don't use it up by the end of the year, it can roll over into the next year and continue to accumulate. You can use a health savings account fairly flexibly, so you can use it to cover a lot of out-of-pocket costs for prescriptions or dental visits, or even like have found, like if you go to the dermatologist and the dermatologist prescribes you a skin regimen, if you are purchasing the products through the dermatologist, you can use your health savings account that way instead of buying over-the-counter products that often can be even more costly. But as Naisha say, is that only available to you through an employer, or if you purchase a health plan through the marketplace, or can you create a health savings account separately?
So with the health savings account, you can get it through an employer, but not all employers will offer it. Individually, yes, you can get a health savings account, or in order to use your health savings account, you have to have a health savings plan that's health savings, it's usually in the name, a high deductible plan that is considered a health savings plan, because with the health savings plan, you do get your annual physical. Again, anything that's preventive in that way will be covered. However, if you go to the doctor, you are paying 100% of the amount that the doctor, the specialist, your medications, everything is being paid upfront by you, the member. And you're paying less monthly to have this plan. However, if you're spending $500, you can then write that off. The health savings account is where you're putting your money. So you open an account, either HSA Bank, their Key Bank. There's another new one that I heard about that I have to research a little bit further. It's also online, where you can put the money in there. And there are limits each year. If you're individual or you have a family plan, there are some limits of how much you can put in there, and they will not let you put in more, because then you're non-compliant, and then the IRS, it is again, tax law, so the IRS will say, and you'll be penalized if you put too much money in there, so they won't let you do that. But if you're maxing out every year and you're investing that money can grow. Once you turn 65, you can use that money for whatever you want. There is no penalty. But while you have it under 65, you can use it for anything you want that is medically necessary. And it could be even over-the-counter, some over-the-counter prescriptions, which is not a prescription, but just over-the-counter medications, first aid kits. So anything, there's a flexible spending account, health savings account. You can purchase about the same things that if you can get it at a pharmacy, for the most part, it's going to be covered. Most debit cards that are health savings account, when you swipe it, it will know if it's an item that is health savings compatible or not. And if it's not, it will trigger it. You may have to provide a receipt for it. You could be audited. So a lot of times you just want to keep all your receipts, take pictures of them, upload them. That makes it a lot easier. But if you have that debit card, it'll keep you out of trouble than if you're having to, if you're just paying for it yourself and you think, oh, I can use it. The other thing about a health savings account is that you do not need to have a health savings account in order to use your health savings plan. You can just use your credit card savings that you have, so you don't necessarily need to have it. However, it's a great idea if you do, because if you have a health savings plan, then you're putting money into the health savings account. You'll have money for when you need it. Because a lot of people, that's the mistake they make with HSAs, is that they don't save the money. And then when they go see the doctor and they get a $300 bill, they're in shock. And now it's like, I don't have the savings, or I do have the savings, but I don't want to pull it out of savings. They put it on a credit card. Now they're paying interest on the credit card to pay this. And it's like this vicious cycle. So, and then it defeats the purpose of having a health savings account, because now you're paying interest on money that you could have saved. So it is money that you can save. It is money that you can grow. It is money that after you turn 65, you can pull it out without a penalty. You still may have to pay taxes on it, ordinary taxes on it, but you can use it for anything you want. Under 65, if you use money that's in a health savings account for non-medically necessary things, medical, dental, vision, you will be penalized on top of having to pay taxes on it. Don't do that.
Noted. Okay, thank you for that. Let's talk about kids. And I know your answer is going to be that it depends, but let's just walk through a couple scenarios. Let's say, you've got young kids. Are you looking at let's say you're a middle income family and you've got young kids under the age of like 15, for example, or even under 12. Should you be looking at a low deductible plan or a high deductible plan, most likely, assuming that your kids are normal, active, maybe play some sports, there's going to be a broken leg in there somewhere, there's going to be some braces that are needed somewhere, that kind of thing?
So when it comes to kids plans, if you are through an employer plan, whatever plan you pick for you, your kids need to be on it. If you have one child in a plan, it may be a little bit expensive than getting an individual plan for them. But if you have 3 kids on a group plan, the rates are based if you're under 50 in the group size, not your age, but the group size. If you're under 50 employees, your plans are based on the average age of who enrolls. And that employee plus child or children, whether you have 1 or 5 children on that plan, the rate will be the same. And that middle of the road plan is usually a good one to have because in case something does happen, you have that lower deductible, you have that lower max out of pocket, but you can still have access to going to the doctor and specialist medications and your physical therapy, all those things. If you're going to get an individual plan for the child, then one thing to look at is if it's a family of 4 making less than $80,000 a year, household income adjusted gross, then the children are probably going to be eligible for Oregon Health Plan or CHIP, which is the Children's Health Insurance Plan that's through the state, which means the family doesn't have to pay for the health insurance of their child, but they are bound to wherever Oregon Health Plan or Washington Apple or California Medi-Cal sends them to. They are stuck on those providers because there are only certain providers that are contracted. So then it's what's most important, be able to take the child to where the child has always gone to their pediatrician or saving the money.
Okay.
Kids that are under 20, they can get an individual plan for not too expensive. It just depends on their needs. And even an individual plan can be fairly inexpensive for like 1 or 2 kids. Once you start getting 2 to 3, it's better if they're on the group plan for their employer. Individually, it won't matter. It's the price of every single person. Even if it's 5 kids, it's 5 times 200.
And correct me if I'm wrong, but right now, kids can still be on your family health plan up until they are 25?
20, well, technically it's 25. The month they turn 26 is when they get kicked off. So if May 15th is their birthday, they will be kicked off on April 30th. And then on May 1st, they need to get their own individual plan. And the beauty of that is that the child can be married, have a whole family, but they can still be on their parents' plan. They can't be kicked off, so that does not matter. But if they're on an individual plan through Marketplace, the question is, who reports that individual on their taxes? If that individual is doing their own individual taxes, they really should be off the plan. I just had a family do that. They said, daughters in college, and relying on them. Okay. So the one question that I always ask, and I didn't ask it this time, was, does the child do their own taxes? Do they make any money? They made it seem as though the child was relying on them 100%. Okay. It was only 2 months out of the year because they were losing their COBRA, got them enrolled in the plan. And then just a couple of weeks ago, they called and they said that the daughter's IRS tax return was rejected because she had not done her own Marketplace plan. She was under the parents, and the parents never claimed the dollars that the daughter was making, didn't claim them on their taxes. It was a mess. The good thing is it was only 2 months worth of a plan, so it wasn't too bad. We were able to fix it. But for this year, it's like, okay, what are you going to do? Who's going to claim her? How are we going to do this? So all these other questions came into play. So if it's an employer plan, keep them on there, no problem. Individual Marketplace plan, then that's when the parents can still help the child pay for the insurance, but if the child is doing their own taxes, then they need to have their own individual plan on their own, which a lot of times behooves them, because if their income isn't that high anyway, they're going to get that higher deductible, or higher tax credit, which helps them pay less monthly.
So let's move it forward then and assume that, one or both parents actually reaches retirement age and then goes on to Medicare. But still, the family still has children that are, under the age of 26 and need coverage. What do you advise for people in situations like that?
When they know that the child is going to lose coverage, start looking then. Don't wait till, lost my coverage is being lost on April 30th, and now you only have 5 days to find something. We want to look at it ahead of time. We have 60 days before and after the individual loses coverage in order to help them find new coverage. So they're still going to have coverage, but there might be a gap. So once they know I'm going on Medicare, whatever month that is, of middle of the year, we can start looking for an individual plan for those children. And then we can look at the situation. Are you still claiming a mom and dad? And if so, then where's the income? And then we can see, does the child qualify for tax credit if you're going to be claiming them? Or are they doing their own taxes, in which case now we want to put them on their own plan. But we want to do it ahead of time. We want to know where are they going to their providers, what's most important to them. Do they need dental plan? Can they go on COBRA? Is that going to be an option for them? Some employers will allow that for the dependents that are losing coverage. They can go on COBRA for up to 18 months. So there's a lot of different things that can come into play, but talk to a broker. I tell people, somebody said, well, why should we use you? And I said, because it's not going to cost you anything. I'm going to make things easier for you. I'm going to answer questions. I'm going to ask you questions to keep you out of trouble. And it's the commission we get paid is already embedded in the premium. So whether you use a broker or not, your rate is your rate. So we're going to ask those questions, and we're going to look at what is best for that child, that individual, whether they're, in their 20s or their teens, what's going to be best for them, what's going to be best for the family. We want to make sure they keep their providers. That's important. And then we're going to guide them and make sure that we're hitting the timelines to make sure that there is no gap in coverage.
Got it. Thank you so much for that. I do have a question, and forgive me, I think we're going to have to do a whole different segment on small business health insurance for people who own small businesses and want to offer that to their employees, because we've gone this whole time just talking about a lot of other topics. But I do want to get this question in because it was posted on Instagram and I wanted to get this answered. Little Hank75 on Instagram wants to know, can you ever have too much health insurance?
It depends. Yes, you can. If you are a healthy individual and you have a really low plan if it's through your employer and you can get that low cost plan that you're not paying that much for it, then take advantage of it. Get that $10 copay, which it's hard to find nowadays. The Teamsters, oh my goodness, they have amazing plans. So is it too much? No, it's just an amazing plan. But if you're having to pay for it, you have to ask yourself, do I really want to spend the money on this lower deductible plan, that gold plan that I'm going to be paying less, when I can still have the same amount of copays, only it might be a $2,000 deductible plan versus a zero deductible plan? It's looking at those little nuances. Could you? Possibly. But the thing is, you never know when something can happen. I was getting some additional supplemental plans. I have accident plan, which I've used because I do obstacle course racing. I do half marathon racing. It's not if I'm going to get hurt, I know I'm going to get hurt. That's the supplemental plan that I've used the most. I have disability insurance in case I cannot work. I have surgery and I'm out for a month. Guess what? I need some bills to get paid. So that's what disability insurance is for. I also have another indemnity plan that's for if I'm in an ICU. And then I have another one that in case I have a specific disease. My mom had dialysis. She was on dialysis for 13 years. She went on end-stage renal when she was 67. So those are things that run in my family. I know can happen, but I want to just make sure that I'm covered. That's my peace of mind. So for me, no, it's not too much. I think it's just the right amount of insurance that I have. So unless you're really questioning, hey, do I need this? It's, do you have the money set aside if you don't have it? That's the question to ask. If you're going to be putting money aside to pay for any of these scenarios that could happen, you know what, you're good. You don't need the insurance. But if you're not going to have that discipline to put money aside, then you know what, paying that little bit of extra money for those policies may be worth it when you start cashing them out. The accident plan, I've used it 3 times, and because I've had to go to urgent care, gotten x-rays to make sure that I didn't have a broken hand, to see if I had a broken foot, and then I had physical therapy, I had surgery on my ankle. Guess what? I got money for all those things that help pay for my cost of insurance and the medical plans. So the answer is it depends, but not usually, at least coming from the insurance, and I'm risk adverse, I'm going to pass on. That's what insurance is for. You are passing on the possibility that something could happen to somebody else to help pay for it when it does happen, just like your car insurance.
That's wise advice. Oh, we'll be sure to include all of your contact information in our notes so that people can get a hold of you and talk through their individual situations with you. Gladys, thanks so much for being on That Expert Show. Thanks for having me, Anna. We'll be creating a tip sheet based on Gladys's insight on this topic. We'll post it at thatexpertshow.com. You can always check out previous episodes of our show on our YouTube channel. Just search for That Expert Show. And we also put out our show as a podcast. So Apple Podcasts, Google Podcasts, wherever it is that you listen to your content, look for us, subscribe. We'd love to connect with you there. And I love hearing from you. I love your feedback and your questions and your suggestions about what I should do next, who I should interview. I'm on Facebook, Twitter, and Instagram. Just search for Anna Canzano. We are live Monday nights at 7 o'clock in partnership with The Oregonian. Thanks so much for being part of the show. It is That Expert Show, and it's where you help run the show.